Hello and welcome to the Mutual Fund Show. I'm Niraj. Shah. With the next 20-25 minutes, we'll try and do two things. One, talk about a very pertinent aspect about mutual fund investing, and then try and get our experts to answer 2 or 3 of the queries as we do with every show, so that you feel you're a part of the show as well. And that's the small attempt that we are trying to do here. Well, the topic today, at any point of time, viewers, you would have a plethora of options of investing in the mutual fund show. Say you want to start an SIP today, or you want to do a lump sum investment today, and you would ask yourself or look around and think about, where is it that I should start an SIP, or where is it that I should make a lump sum investment? Now, is there a right choice at all the times? I would argue yes. Now, if you're wondering that you want to start an SIP today, but you don't have an idea about where is it that you should, or what are the options that you should look at, today's show, we'll talk about one such option which might be a good fit in the current scenario. At least I feel it might be a good fit, and I'm going to ask my experts if they believe the same about this or no. Now, because markets are trading the way they are, we are 3%, 4% off the highs, but circa new highs. Because large caps are trading relatively at a safer valuation than mid caps and small caps, and because there is uncertainty around what will happen with interest rates and thereby fixed income instruments, should one look at managing the portfolio in a dynamic fashion? And therefore, would dynamic asset allocation funds, wherein the fund manager will do this job for you, be a good idea under the current scenario? Let me pose that question to both our experts today. I'm joined by Rushabh Desai, founder of Rupee with Rushabh Investment Services, and Mohit Gang, co-founder and CEO of Moneyfront. Gentlemen, both of you, thank you so much for taking the time out and joining us. And Mohit, great to have you in our studio. Rushabh, great to have you as always on the show as well.
Thank you so much, Niraj.
Pleasure is entirely ours. Mohit, can I start with you? Is this a good idea to look at dynamic asset allocation funds under the current scenario? Why or why not?
Okay. Thank you so much, Niraj. Always a pleasure to be on your show.
Thank you.
Look, to me, I think there is never a bad time for a dynamic asset allocation fund. Okay. Is this a good time? Perhaps this might be a great time to get into that category. But again, as I say, there's never a bad time, because it gives you a good blend of everything, right? A mixture of equity, debt, some bit of commodities and few other assets, depending on what category or what fund house you go into, and a component of arbitrage which plays and gives you that equity taxation. You get the best of all the worlds, right? With equity taxation, getting fantastic returns, giving a safety cushion, having a protective net in your portfolio, getting the upside from equity markets, checking into the growth rates. I think you can't ask for a better combination. And as I said, there's never a bad time for this category.
Okay. Rushabh, well, Mohit kind of firsts my thought here. I would love to understand from you, because this stems from a conversation that we were having yesterday as well. I presume you would second this.
Niraj, absolutely. I completely second what Mohit had to say. There is never a bad time to invest in dynamic asset allocation funds, whether it is at the peak of the market cycle, middle point, or the low point. There are a few reasons why I really strongly feel dynamic asset allocation funds are today in a sweet spot. There are 4 particular reasons for this, Niraj. One is, see, these funds are dynamically managed between equity and debt. So the fund manager takes real active calls. When the markets are expensive, they trim down the pure equity allocation and venture more into debt. And when the markets are low, valuations are low, they venture more into equity and reduce the debt, right? Second is that if you look at the market scenario, which you correctly put it and summarize it very well, mid and small caps are trading at a premium. Large caps are trading at its historical average, so it's quite reasonable compared to mid and small caps. See, today equity markets are also volatile, which is positive for the arbitrage spreads. And we are uncertain about the rate cut. So currently, as we speak, debt yields are trading at its peak range. Now, if you see the portfolio of these dynamic asset allocation funds, I took out some very interesting data at a category average level. It's quite balanced between equity, debt, and arbitrage at this point of time. See, the average pure equity allocation in the dynamic asset allocation category stands at around 53%, and the debt and arbitrage allocation stands at around 47%. Second is that, because large caps are reasonably valued at this point of time, the equity portfolio in these dynamic asset allocation funds, stand particularly at 75% large caps. So these are very well positioned to take the benefit of the large cap rally when it happens over the next 2 to 3 years. And if you see the debt yield and the debt average maturity of these portfolios stand at around 5 years, and the yield to maturity at the gross level stands at 7.5%. So I feel a combination of these factors, looking at the portfolio of these funds over the next 3 to 4 years, I really feel tremendous upside opportunity can be made. Good amount of double-digit returns I feel can be made from dynamic asset allocation category, Niraj.
Okay, so let's try and simplify this, Mohit. For somebody who's wanting to know that they've heard you and they know that this is a good category, what kind of funds fall within Dynamic Asset Allocation Fund? Would a fund be called, for example, ICICI Prudential Dynamic Asset Allocation or HDFC Dynamic Asset Allocation, or is it something else? And would you recommend an SIP in this category? Would you recommend an STP if somebody has a lump sum, or would you recommend a lump sum investment as well?
Got it. So Niraj, I think first things first, I think Rushabh has brilliantly explained what it entails. Just adding one more point to it. Look, for investors who can't themselves track the market very dynamically and can't create a balanced portfolio or can't decide what mix of equity and debt to have at what particular market cycle in their portfolios, this is a brilliant category to have because it auto fits, it auto tunes your portfolio under all market cycles. The fund manager himself is dynamically switching between equity and debt, and he's increasing the equity composition as markets get attractive, and reducing it when markets get extremely riskier or pricey or whatever you might call, right? So for those category of investors, it's a brilliant call. Whether to go SIP or lump sum, look, honestly, it's a case of a very unique condition to every investor. If you have regular flows, if you are a salaried investor, then perhaps SIP is the best choice for you to go. But if you are sitting on a lump sum, which is by virtue of your year-end bonus or by whatever reasons, then I would say stagger it out for not a very long period, but let's say 3 to 6 months, just take an entry for a couple of reasons. One, debt yields have been fairly elevated for some time now. They eased off to around 6.9%, the 10-year in India, but went on to around 7.1, 7.2 now. US is already at a very high 10-year yield again, right? And the rate cycle, which was looking imminent for a reduction, is perhaps a little delayed now, right? So my sense is spreading those funds for next 3-4 months might mean a good entry point in the debt cycle also, if we were to see the yields again shooting back a little. And second, equity, because we think there is some amount of volatility owing to elections and other things, maybe a 2-3 month kind of a staggering, but not for someone who can have the appetite for risk and have the appetite for volatility, perhaps go out, all out and do a lump sum. But for, I think, a normal retail investor who is a little fearful, wants to take a calculated call, a 3 to 6 months kind of an STP is a better choice to take into this. What kind of funds come into this category? Most of your balance advantage funds, like your Pro ICICI balance advantage fund, your HDFC balance advantage fund, which is one of the biggest AUM fund in this category, almost 80,000 crores of AUM under that. Your Edelweiss balance advantage funds, right? So typically you will find the name balanced advantage. You might also find the name of asset allocation funds. So you will have those kind of asset allocation funds also in this. Again, you will have to go into the underlying tone and theme and try and understand what the fund actually does. There are some funds which actually work on the fundamentals of the market and change equity debt allocation depending on the P ratios and PB ratios of the market. And there are some funds like Edelweiss who more track the technicals of the market and the momentum of the market and then change the composition of the equity and debt. So what is the underlying tone and methodology of each fund? Perhaps an investor will have to be a little more cognizant and maybe take help of his advisor in selecting it out. But again, that's the broader category. But I think it's an all-season category.
Okay. By the way, viewers, before we take the break, we will make you hear the Home Minister talk about market volatility as well, since we're talking about taking advantage of the volatility. But there is still some time for the break. I just want to wrap up this topic first. And Rushabh, I'll come to you therefore. How do you look at investing in this space? As Mohit was saying, that there could be various nomenclatures and each fund maybe approaches this shifting or being dynamic in this quite differently. So where is it that you find favor within this landscape of this dynamic asset allocation funds?
Niraj, Mohit brilliantly explained, the dynamics of this particular category. There are two types of funds which Mohit also explained. One is the pro-cyclical and one is counter-cyclical. Pro-cyclical is usually follows the technicalities, the momentum strategy. It's a little more aggressive towards equity, and counter-cyclical is more like to do with the valuation game, P, PB ratio and stuff like that. So I think a combination of having a pro-cyclical and counter-cyclical fund. To give you an example, see, the Edelweiss BAF product is a pro-cyclical product. It's a little more aggressive towards equity. And the ICICI Prudential Balance Advantage Fund is the counter-cyclical product. So having a pro and a counter-cyclical product, works best. As Mohit correctly pointed out that, spreading out investments over the next 2-3 months would be ideal. I wouldn't go beyond 2 to 3 months because we don't know, because now the market cycles have also shortened. So the volatility also has shortened. So take advantage, if the markets fall by 1% or so, you might want to invest a good amount of lump sum money during that time, but not more than 2 to 3 months spreading out. This is something what I would, give my opinion on. And, last but not the least, both SIP and lump sum methodology works great. This is more of a category for moderate risk takers, who don't want to venture purely into equity and don't want to take that pure equity risk. This is more of for a moderate risk taker. But if someone has a longer time horizon, say like 7-10 years, doing an SIP, if someone can take risk, and doing an SIP in pure equity products would work best to give you better risk adjusted return. But someone who cannot stomach that much of volatility, or probably who has a medium term time horizon, this category fits best for them.
So Rushabh, one, what are the kind of returns to be anticipated for a moderate risk investor if she or he invests in this category today? And what are the recommendations? They will not be exhaustive recommendations. You could choose 2 out of the many that you like, but share a couple of names.
Niraj, I feel the minimum time horizon should be 5 years, anywhere between 4 to 5 years for these products, because over a longer period of time, since these products inception on a 5-year daily rolling basis, these products have given no negative returns at all. So I think the ideal time horizon would be 4 to 5 years. There are 2 products which come in my mind is one is Edelweiss Balance Advantage Fund, and second is the ICICI Prudential Balance Advantage Funds. I think dividing it into these 2 products would be a great portfolio.
Okay, Mohit, from your end?
Look, again, I think here investor will have to get into a discretion of figuring out what kind of an equity composition and what is the aggression level of the funds do they want. If you want a highly aggressive fund with a slightly higher equity composition, then HDFC Balance Advantage is your choice. If
they typically do this, you say?
They are typically on the higher side of the equity composition. If you want a very, very safe, conservative, long-lasting theme, then Pru ICICI Balance Advantage is the choice for you. I think S. Naren has been brilliant in the way he's been managing, and he's very vocal about the way he's been managing this fund, right? And if you want a bit of technicality involved, chasing some bit of momentum in the market and then deciding on equity debt allocations, which perhaps works very well in these kind of markets, then Edelweiss Balance Advantage should be your choice.
Okay, interesting. Viewers, I mean, if I was an investor, I think I got the complete lowdown of this space, why I should or should not invest depending on the kind of investor that I am, and what are the choices out there amongst the many. But I urge you, please do your own research as well. Consult your financial advisor if you have one about this category, but definitely ask your financial advisor why you should not be investing in this category at the current point of time. Both our experts believe it's an evergreen category, and under the current circumstances might be one that you should definitely explore, at least, if not invest in. I hope this conversation helped you. Now, we'll of course slip into a break. On the other side, we'll try and take some of the queries that our viewers send us. But we were talking about volatility, right? And the current ongoing volatility in the market, according to Home Minister Amit Shah, is not a sign of or a signal of BJP's weakness. And the markets, according to him, will surge come June 4th in an exclusive conversation with NDTV's Vikas Bhadoria. Listen in.
16 बार इससे भी बड़े गोते स्टॉक मार्केट ने लगाए। इसको चुनाव के साथ जोड़ना नहीं चाहिए। खैर, अफवाहों के कारण ऐसा हुआ भी होगा, तो 6 जून के पहले आप बाय कर लेना, 4 जून के पहले वो शूट अप करेगा।
तो इस बार पुराने रिकॉर्ड फिर तोड़ेगा, 1 लाख के पार जाएगा क्या?
क्या करेगा, मैं कोई स्टॉक मार्केट के लिए आकलन नहीं कर सकता, पर नॉर्मली जब स्थिर सरकार आती है तो स्टॉक मार्केट बढ़ता है। इसलिए मैं कह रहा हूँ कि 400 पार होने वाला है, मोदी जी की स्थिर सरकार आने वाली है, तो निश्चित रूप से बाजार ऊपर आएगा।
Now, as promised, viewers, try and take some queries. They might be synonymous in some sense, but to each individual person, the query holds significant value. So we'll try and ask our experts about these. The first one comes in from Amit Sharma. Now, Amit is aged 41 years. Amit's goal is to create a corpus of 1 crore rupees. Maybe we have the timeline. We'll get to that in a moment. His query is that he has SIPs in 7 funds and can additionally divide and invest 12,000 crores in those. Can Amit achieve his target through these funds, or does he need to make changes? Now, 12,000 rupees, excuse me, that was the thing. So he wants to invest 12,000 rupees in them, and he wants to invest, whether he should make changes in these funds or no. So the current SIPs are in Axis Blue Chip Fund, 2,500 rupees. HDFC Retirement Fund, about 4,000 rupees. HDFC Top 100, 2,500. So on and so forth. The numbers are there on your screen. ICICI Blue Chip, about 4,000. And then the other 3, which is ICICI Pru Large and Mid Cap, as well as Nippon India Growth Fund in these numbers. Now, Mohit, can I start with you? Have you had a chance to look at this query, and what would you advise Amit?
Yeah, so look, I think Amit is fairly well set with his current SIPs of 21,000. He will achieve his goal of 1 crore by his retirement age, which is 16. So he has 19 years to go. My sense is, Amit, you need to up your goal out there. I think a retirement corpus could be a little higher. So up your goal with additional 12,000 rupees of SIP, which you're planning to do, you will achieve much, much more, right? And if you continue to increase your SIPs, then all the more better. In terms of fund selection, look, if I were to start a portfolio today, I will perhaps not start with what Amit has been doing, but I'm not a big believer of twisting and turning the portfolios. There's nothing wrong in the fund selections which he have, but because he is at 41 years, he has 19 years to go, perhaps he can increase the risk level in his portfolio and include one more mid-cap fund and a small-cap fund in the portfolio. He can go with an Edelweiss mid-cap fund, a Pru ICICI small-cap fund for his new SIPs which he wants to do, right? Otherwise, I think broadly the funds are good, the track records are great, but as I said, if I were to start the portfolio today, perhaps I will not have this composition, and if at all, he can have one passive allocation also. These are all active strategies in his portfolio. He can either go for a Momentum 30 index fund or a plain simple Pru ICICI Nifty 50 index fund.
Quick question. He has got 7 funds. You're recommending adding 3 more, or swapping out of some of these, looking at his age and getting into the other 3?
So I'm not recommending coming out of any of these existing funds, but he can stop SIPs into few of the funds, right? So maybe perhaps he can stop his SIP into a large and mid-cap fund which he holds in his portfolio, and he can start SIPs into a couple of more funds. His portfolio is a little tilted towards large cap. Because he has 19 years, he can go more towards mid and small cap. So that's what I think he needs to do. And because he's also wanting to put in additional 12,000, so that is where if he's doing some additional allocation, maybe adding 1 or 2 more schemes might not harm him a lot.
Okay. You know, viewers, I'll ask Rushabh to give us view on this query as well, because this is a query that could be applicable to many people. It's very similar and synonymous for a lot of people. Rushabh, do you have some thoughts on this? Your thoughts could be different from what Mohit has said, of course.
You know what Mohit had to say, particularly about his retirement, I think he's very well sorted in terms of the amount. He can definitely increase the SIP amount as and when, you know, his annual salary increases. Overall, he is going to achieve 1 crore in 12 years, but since he has a good amount of more years towards his retirement, he can definitely look at increasing more, taking more risk. His portfolio is more inclined towards large cap, and he has quite a lot of funds in the same AMC. This is where I would little bit differ with Mohit, that, you know, having multiple funds in the same AMC could be a concentration risk, and you know, towards the style, towards similar stocks. And if, you know, an entire AMC underperforms, you know, the entire portfolio goes into the underperformance risk at the same time. So, you know, I think diversifying across different styles is very important, and also diversifying across different AMCs is also very important. HDFC and ICICI are both great AMCs, but I would suggest trimming down little more funds and having a maximum of 5 to 6 funds in the overall portfolio over different styles and across different AMCs would be ideal, would be better in terms of risk mitigation.
Okay, well, I hope this gives you some answers to your query, and I hope this helps you in a meaningful way. Very quickly, let's take one more query because we have time for maybe one more. And this one comes in from Shah, who's age 20. I'm glad you're thinking of starting off the investing lesson so early in your life cycle. The goal is a small corpus actually, 1.5 lakh rupee corpus. Okay, not too much. But Sham says he wants to invest 2,000 rupees per month in mutual funds for the next 1.5 years. So there's a time-bound amount. Can you suggest a few funds? Rushabh, can I start with you? Will he be able to reach his goal, and what fund should you choose within this limit?
Niraj, first of all, I would like to congratulate him that at such a young age he's thinking about investments. At our 20s, probably we're not even thinking about investments. There are 2-3 things. He has kept a very short time horizon of 1.5 years. I think if he wants to create wealth, see, no amount is small when you are investing in SIP route in the equity segment, right? But the time horizon is very small. 1.5 years is absolutely very small. I would recommend him to increase his time horizon, to at least 7 years, minimum. I mean, he has a lot of time horizon, but at least have a minimum of seven years time horizon if he wants to do an SIP methodology into equity. Now, if he just wants to stick with 1.5 years, then of course doing an SIP in debt mutual funds would be best. But if he can increase his time horizon to say like 7 years or so, then he can definitely look at investing in a Motilal Oswal Nifty 500 index funds, because he's just starting it. So tasting the equity segment would be much better, because Nifty 500 will give a good flavor of say around 75% in equity, 15% in mid caps, and around 10% in small cap.
Got it. Thanks, Rushabh. Mohit, out of time completely, but very quick advice.
Not an ideal time frame for equities. Need to have at least 5 years to go with that. But great thing that he's wanting to start. 1.5 years, he won't be able to make that kind of corpus which he's looking for. Either increase the amount, but the better thing is to increase the time frame. He has time at his hands. Need not come out of equities in 1.5 years. Not at all.
And I think that's a fair way to get this approach as well. I hope this helps you, Sham, in some fashion. But Rushabh, Mohit, both of you, thank you so much for joining in on the show today and giving us your thoughts. Really appreciate your time. Mohit, thanks for joining in the studio again. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.